Imagine two investors, each with $100,000. One buys VOO, the other buys IVV. Same index, same 500 companies, same Apple, same Microsoft, same Nvidia sitting at the top of both portfolios. They invest on the same day. They don't touch the accounts for 30 years. And when they finally check the balance, one of them is nearly $27,000 ahead. Same companies, same index, different result. Did one fund manager make a secret bet the other didn't? Did one of these funds quietly take on more risk? Or is there something happening in the background that almost nobody ever notices? Stick around, because by the end of this, you'll never look at an ETF ticker the same way again. Every year, millions of investors open a brokerage account, search Best S&P 500 ETF, and land on two names, VOO and IVV, Vanguard's fund, BlackRock's fund, two of the largest, most trusted asset managers on Earth, both offering what looks like the same product. And here's the part that makes this so strange. Most people assume that choice doesn't matter. Pick one, move on with your life. But somewhere out there, a $27,000 gap exists between two portfolios that supposedly own the exact same thing. So which one is it? And more importantly, why? To understand this mystery, we have to go back to where each of these funds came from. Vanguard launched VOO in 2010. It was built on a philosophy the company had been preaching since the 1970s. Keep costs low, track the market, and let time do the work. Vanguard's founder, John Bogle, is often credited as the father of index investing, and VOO became one of the clearest expressions of that idea. BlackRock's IVV came earlier, launched in 2000, under the iShares brand. It was one of the very first ETFs to track the S&P 500, giving everyday investors a way to own the entire index in a single trade. Over the next 2 decades, it grew into one of the largest funds in the world. Two companies, two philosophies, one shared goal. Give investors
ownership of America's 500 largest public companies. So let's start investigating the differences, because on paper there should be plenty. First clue, expense ratio, the annual fee a fund charges to manage your money. VO charges a razor-thin fee. IVV charges a razor-thin fee. The gap between them is so small it barely registers on a $100,000 account. Basically identical. Next clue, holdings. Same companies, same order, weighted almost identically by market size. Basically identical. Sector allocation, technology, healthcare, financials, in nearly the same proportions. Basically identical. Liquidity, trading volume, assets under management. Both funds are giants. Both trade easily. Both are backed by hundreds of billions of dollars. Every single clue leads to the same dead end. These funds are not just similar. They are, for almost every practical purpose, the same product wearing two different labels. So if everything matches, where does a $27,000 difference even come from? Let's look at performance history, because this is where things get interesting. Over the past 1-year stretch, one fund edges ahead by a hair. Over 5 years, the lead sometimes flips to the other. Over 10 years, it flips again. Neither fund dominates. They trade the lead back and forth like two runners who never quite pull away from each other. At this point, you'd expect the story to end in a tie, but it doesn't. Here's the number that started this whole investigation. Financial researchers have pointed out that a hypothetical $100,000 invested in one of these S&P 500 ETFs versus the other, held for 30 years, can finish with a gap of roughly $27,000, depending on the exact starting and ending points measured. $27,000 from two funds holding the same companies. So did we finally find the better ETF? Not so fast. Here's what almost nobody explains. That gap isn't proof that one fund is smarter, safer, or better managed. It's
the result of something far less exciting: measurement. When you compare two nearly identical funds over decades, tiny mechanical differences start to compound. Dividend payments, the cash companies pay out to shareholders, get reinvested on slightly different days between funds. A tracking difference, meaning how precisely a fund mirrors its index day to day, can create fractions of a % of variation. The exact start date and end date you choose for measuring 30 years can land on different market conditions entirely, since markets don't move in a straight line. None of these are secrets. None of these are advantages. They're rounding, timing, and the luck of which exact days you happen to measure. Stretch that across 30 years of compounding, and small timing differences can turn into a number that looks dramatic on a chart, even though the underlying investment was virtually the same the entire time.
So the mystery wasn't really about which ETF is better. It was about how easily a tiny, meaningless gap can look enormous once you compound it over decades. And that's the actual lesson here. The real risk was never choosing VO over IVV or IVV over VO. The real risk is the years an investor spends sitting on the sidelines trying to find the mathematically perfect choice while their money sits in cash earning nothing at all.